Hello, I'm Ellie Dowding.
And I'm Lee Coates. Together we are ESG Accord and the Accord Initiative.
You're listening to Accord Talks, a podcast about sustainability, compliance, and advice processes supporting the financial advice sector. We hope you're all well. Okay, so episode 2, exciting. How are we feeling about the launch of the podcast?
Well, I think it's been really great, the engagement we've had from advisors so far, suggesting further topics for future podcasts. I mean, how great to be asked to talk more about ethical and faith-based investing. That's brilliant.
Yeah, I completely agree. So please do keep suggestions coming in. We want to make these podcasts super relevant to the industry. So we need you, our listeners, to help us do that.
So, today we are going to be talking about the findings from the FCA's latest Financial Lives survey. This is a real favourite topic for us at ESG Accord.
Yeah, but I think before we dive into the subject matter, I think we need to backtrack a bit and talk about the Financial Lives survey, set the scene more generally.
Okay,
So,
good
yeah,
idea.
the first thing to know is that a total of 17,950 respondents completed the FCA's survey, this time the 2024 survey. The latest survey, it was published in May, so that's 2024 results. The latest edition is the fourth in a series showing a snapshot of consumers' attitudes and financial circumstances since the FCA's first survey back in 2017. So the series allows the FCA and the wider industry to compare how product holdings, finances, and experiences have changed over time. So there's this main report, and then there's a set of slide-based reports which focus on specific retail sectors and subject areas. So for the purposes of this podcast, we're going to focus our highlights from section 6 of the Consumer Investment Selected Findings, which is all about responsible investments. And
Hooray.
yeah, I know. And I must tell you that we're going to put a link to these selected findings in the show notes for the episode. And we will mention the page numbers as we talk through the podcast so that if you want to, you can refer to the document easily.
Yeah, so before we actually start looking at the individual pages and all the stats and fantastically wonderful information, what I want to do is look at some of the terminology because the FCA has very clearly outlined what they mean by
Yeah.
responsible investment. Now, I'm going to have to read this from the slide because it's quite a long-winded one, but it's important. So, according to the FCA, responsible investment means investing in a way that takes into account not just how companies are managed and how they are performing, but other issues too, such as whether companies act to protect the environment, have a positive social impact, and treat their employees fairly, or are governed well and operate with integrity and transparency. People might choose these investments because they care about these issues and how their money is invested, and or because of how they expect these companies to perform over the long term. End quote.
Yeah, I think that the terminology that the FCA has used is really interesting. So, in this definition, as opposed to the earlier definitions, I like that responsible investing is now more like a vision almost. So it's more like investing in what aligns with your principles and possibly to do well while doing good, and reflect your values. And that's rather than it being about materiality or appearing like a warning statement, even. So I think it's great that it was defined like this for respondents.
Yeah, and I think what advisors need to understand is that with Consumer Duty and SDR and the results of the Financial Lives survey, the FCA probably isn't going to accept the "my clients aren't interested in it" anymore response. The FCA's evidence contradicts this statement, as we'll see later. So it's really incumbent upon advisors to show that clients are making an informed choice not to invest sustainably, which is what they're allowed to do, rather than advisors making that choice for them.
Yeah, agree. So, okay, shall we get into the slides?
Let's do
We're
it.
going to move, yeah, let's move to page 72 of the selected findings. 72 looks at investors' awareness of responsible investment. So results in the 2024 survey shows that awareness was highest among those with investable assets of 100,000 plus older age groups and men. So statistics show that 67% of males are aware, whereas 49% of females are aware. I think this is perhaps a reflection of the gender investment gap, and that is increasing according to Boring Money research. So they say that there are now 3.3 million more male investors in the UK. That's 6.7 million women invest compared to 10 million men. So the gap widened by 200,000 people in the past 12 months. So I guess it's difficult to read this really and say it out loud, but I think I view this as untapped potential for advisors. And Hargreaves Lansdown research shows that women in the UK are expected to be significant beneficiaries of the Great Wealth Transfer, with projections suggesting that they'll control a majority of the UK's wealth by the end of 2025. So that's big numbers and a lot to think about. And yeah, untapped potential, I think.
Yeah, I mean, that's just listening to you quote those figures, Ellie. It strikes me that this is due to several factors, really, including women's longer lifespans,
Yep.
which often result in inheriting assets from partners and the transfer of wealth from the baby boomers generation. And I suppose that and horizontal transfer of wealth and financial independence. And then, of course, you could add to that the fact that a recent UBS study revealed that more women, 71%, make investing decisions with wider sustainability considerations in mind compared to 58% of men. Now, all of that really reinforces my experience of 30 years as an advisor, where we found that women were significantly more active and engaged with their money once advisors starting talking to them about their personal values. It makes sometimes quite abstract financial concepts far more accessible when investment strategies are discussed in the context of environmental or social issues. A more holistic approach to providing advice, really.
Yeah, agree. Okay. So that's that one done. Shall we move to the next slide on page 73? So this one shows that there's a majority of 54% of people who have any investment or DC pension are interested in investing responsibly. So I think that this one for me is quite interesting from a cross-cutting regulatory perspective. So according to the FCA's recent CP 2517 consultation paper, that's the one about proposals for targeted support, only just published this June. Only 9% of people receive regulated advice on their pensions and investments. So the consultation paper goes on to state that many people are holding cash and don't invest because they don't know enough or feel overwhelmed and need support. So I think certainly from a consumer duty and informed choice perspective, this tells me that there is absolutely, again, a gap for advice of some kind, be that independent personalized advice or targeted support solutions to educate clients about their preferences for investing. And I think, yeah, a personal viewpoint of mine here is that the advice or support must also cover non-financial objectives as well as purely financial outcomes.
Agree with you on that
So
one.
yeah, and so the SDR's consumer-facing disclosures do, of course, help in this space. But is the message getting through to the consumer? I'm not entirely sure at this point. But I think that, again, it's a gap where advisors can definitely step in.
Yeah, and what I find interesting is that if the recent commentary in the trade press about more people seeking advice is actually correct,
Mm.
then perhaps one of the catalysts to get people to seek advice and move that money from cash, as we're hearing all the time now, is talking about responsible investment. Simple as
Yeah.
that. That might be the one thing that people go, oh, okay, that's more interesting now,
Yeah.
rather than alpha, beta, and pound cost averaging and all the stuff that um, advisors tend to sort of default to about the financial aspects. Actually, start talking to people about what's of interest to them. Okay, next slide. So
Right.
this is page 74, and it tells us that of those who have made investments or have a DC pension, 18% have invested in responsible options, and 11% have made it an active choice. So those figures are a bit obviously less than the level of interest. So one question is, why is the level of interest 54% and the actual act of doing it is 18%? Maybe that's a rhetorical question for this podcast. But whatever, the numbers are quite low when you look at the FCA's 22 survey results, which showed that 74% agreed that environmental issues are really important to them. And then 79% agreed businesses have a wider social responsibility, more than simply just making a profit. And 85% strongly believed businesses have a duty to pay their employees fairly, have a diverse workforce, and control executive pay. Now,
Mm.
something doesn't quite add up. What people are saying they want and what they're actually ending up with are at complete odds to each other.
Yeah, agree. I mean, the 2022 statistics are really high statistics there, and it really shouts to me that people's views are not getting factored into their investments yet. And yet is definitely the word there because I just have to say it. It's what we do at ESG Accord and the Accord Initiative. After all, we help advisors, sorry, ask clients simply and confidently in this area. Okay, so moving on to page 75. This one talks about the different types of responsible investments that people have made. Personally, I think that we are seeing the importance of a fund name and simplicity of fund structure here in the results of this slide. It shows that 41% have invested in an eco or green fund, 36% in a negative screening fund, and 32% in an ESG or sustainable fund. And I think from this, we can see why the FCA's sustainability disclosure requirements have needed to deliver and have delivered the correct guardrails in terms of the naming and marketing rules.
Yeah, well, I'm going to go straight back to my earlier comments on advisors asking the clients and actually
Yeah.
finding out what the clients want. Because these figures show that people increasingly want to choose to invest in responsible options, but there isn't a one-size-fits-all solution. If you break this down even further, what it indicates to me is that many investors need help and advice. So this is perfect territory for financial advisors, but it's essential that advisors raise the subject and help guide clients through the options.
Great.
Okay, we're going to do slide or page 76 now.
Yeah.
And this states that 72% of investors would like the way that their money is invested to do some good, as well as provide a financial return. Just say that again. 72% investors want their money to do some good, as well as make money. 65% would like to invest in a way that is protecting the environment. 69% would like to invest in a way that has a positive social impact. And then 73% would like to invest in companies that have strong governance practices. I'm going to giggle now. Well, I have giggled, so I'll stop giggling and read out what's making me giggle. And it's the fact that I'm confused. See, if you flip the 73% figure around, the 73% that want good governance, that means somewhere out there, 27% of people would be happy to invest in companies that are badly run or perhaps even rather dodgy, as long as it makes money. I think that one might need a bit of unpacking
It's a
because it
concern,
makes
isn't
no
it?
sense to me.
Yeah.
Woo.
Yeah, I think my comment for this one is just to echo our previous comments. And I think that when the choice is provided to a client, these statistics will certainly speak very loudly for themselves because they're high numbers. Simple as
Mm.
that.
Yeah.
Okay, so page 77. On page 77, this one is an important slide, I think, for advice firms when structuring their advice models and meeting consumer duty, price, and value elements. So it looks at investor willingness to take greater financial risk or accept higher costs with responsible investments and likely future performance of responsible investments. So interestingly, 25% of people agree that they'd be prepared to take greater financial risk with a responsible investment that they would rather than a traditional investment. This one I think is super important to highlight from an advice perspective. And to be honest with you, it makes me feel quite edgy from a compliance point of view and for
Yeah.
consumer duty outcomes. So what do I mean by this? Let's think about environmentalism, for example. With this, the first thing to consider is that the client may fall into the territory of being a protected group. So care needs to be taken identifying views. Secondly, has the advisor considered if the client is feeling climate anxiety or grief, even bereavement for, loss of biodiversity, any of those areas, a significant bereavement. This could take us into what's potentially vulnerable client territory. The client being made aware, then, let's go a bit further. The client is made aware of being able to match their preferences and objectives via their investments. So they've
Hmm.
potentially got really high expectations of what these investments could achieve. And they may, in a state of grief or anxiety, not be thinking perhaps clearly about the risk that they're prepared to take or are capable of actually taking on. So,
Mm.
yeah, this raises loads of possible compliance issues for me. And I think,
Yeah, whoa,
yeah.
whoa, 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 hang on, whoa, whoa, hang on a minute, Ellie. Hang on, I'm just going to get my head around that. So
Yeah.
those are really significant bombs you've just dropped in there.
Mm.
Vulnerable clients, climate anxiety. Um, Here's a suggestion. Let's look at these areas in detail in a separate podcast when we've had a
I
chance
think
to
so.
actually think about it. We could then look at things like the advisor sufficiently managing the client
Yep.
expectations. I don't know, what does the file disclose about the conversation on risk?
Yeah.
Okay, let's leave it there for now. And then we'll work on that one.
It's a big, big topic,
Ooh,
a
yeah.
can of worms even, I think. So yeah, let's definitely do that in another podcast episode. Love that.
Move on.
Um, Also, another point, before we move to the next slide,
Okay.
on this one, 22% of people agree that they would be prepared to accept higher costs with responsible investment than they would with a traditional investment. So, this one shows me that there's space for specialized and skilled advisors and the opportunity for bespoke advice models for clients with detailed needs. So, yeah, interesting.
Yeah. Okay. So, page 78. Now, this one shows the proportion of adults who have already invested in responsible investments um, before and who agree with statements about checking fund credentials. So they were basically asked, how do you feel about what the funds are telling you? And interestingly, 68% of people find it hard to tell which funds are genuinely following responsible investment principles and which are not. The data also confirms that only 45% of people received enough information to assess the fund, and only 29% checked if the fund information was verified at all.
Yeah, it's hard reading that one, I think. But I think it really shows the need again for the SDR, that's the sustainability disclosure requirements, which you must remember on this when reading out those stats that the SDR only went live from the 31st of July
Yep.
2024, and the
Mm.
financial live survey took place between the 5th of February 2024 and 16th of June 2024. So I've got a strong feeling that when the FCA do the next survey, we'll see much more confidence and trust.
I hope so too.
Yes, definitely.
Otherwise, we'll be looking at SDR again.
Yes, we'll be having another podcast about that. Okay, so moving to page 79. This one is another SDR insight slide. This time it looks at the anti-greenwashing rule. So the survey results show that a large 46% of people say that from their experience, providers of ESG or responsible investment products often overstate the sustainability credentials of these funds in
No.
their marketing.
That wouldn't
Um,
happen.
but yeah, I'm going to talk back again about when the survey results, what the survey, the time period that the survey results apply to. So the anti-greenwashing rule only went live on the 31st of May 2024. And again, yeah, the Financial Live survey is February to June 2024. So the effects of the SDR are not yet shown here. So what I think is interesting, though, to point out is that the Investment Association's SDR survey that was published in June this year, that was about testing SDR sentiment. It showed that something like 80% agreed that the SDR regime has successfully reduced greenwashing across the industry. So again, we wait to see what consumers think in the next Financial Live survey.
Can't wait.
Yeah.
Okay. Right. That's jumping us to 2027. God, dear, oh dear. Okay. So moving on to page 80. I love this one.
Okay.
Now, this slide is perhaps the most important one for consumer duty and informed choice. Well, I
Mm.
think we've said that a number of times today.
Mm.
Consumer duty and informed choice, and knowing your client. And I think it directly points to our work on the Accord Initiative website. So a big thank you to the FCA for adding this question to the
Yeah.
survey.
Thanks, FCA.
Yeah, woo, thank you. Right, what it actually shows is that 76% of adults with any investments or a DC pension thought it important to be asked if they wish to invest responsibly when selecting a pension or receiving advice. So 76% want to be asked. They want to be loved. Now, it showed that if it's 76% of adults with any investments or a DC pension thought it important to be asked if they wish to invest responsibly, then this doesn't actually mean that 76% want responsible investment. It just means that 76% care about being asked. And there's an important difference. So the FCA are saying essentially what they're saying through these stats is that people want to know their advisor is trying to get to know them and not just forcing things on them. So whether a client wants to invest sustainably is almost irrelevant. The fact that they're asked, they can think about it and then say, yes, please, or no, thank you. Um, that's what's most important to them. And if you do that, then you've got really good client engagement and you've got an informed client and you're on the road to consumer duty happiness.
Yeah, I think the slide really, really matters. Clients expect their financial advisors to offer options, and that's not only their financial goals, but also broader concerns, and that, yeah, could be sustainability, governance in the majority, and
Mm.
social impact. Okay, so I'm going to have to say this because it's too good an opportunity to miss, really. It's to highlight our free to access suitability toolkit. So it's for advisors and it's all about client preferences, informed choice, and it's a toolkit that they can use. It's available on the Accord Initiative website for you to download now. So please head over there and do that. So gosh, I think time-wise, we need to start concluding things. There's been so much information. I've loved it, but I think we
Mm.
need to end, I think, with some action points for the advice community.
Right.
Yeah.
Action points. Okay, so we've had lots of stats, lots of detail. So what are the practical takeaways for advisors and those offering responsible and sustainable investment products? Well, I'm going to kick off with two. And
Mm.
the first one, probably rather obvious, is ask every client. Really simple. Don't assume interest or lack of interest is based on age, sex, or wealth. Clients want to be asked. We know that 76% of them want to be asked. And asking shows you're listening, not leading. Use tools like our sustainability toolkit, I should say our free to access sustainability toolkit, to guide the conversation confidently, and I think from a compliance point of view, consistently.
Yeah.
Ask the same thing in the same way of all clients. The answers are going to be different depending on what the client wants, but by asking the same thing in the same way at the same time of all clients, that's very consumer duty friendly. So remember that the toolkit's available. It's free. to access on the Accord Initiative website, thanks to the support of our partners. And the second point I want to make is go beyond the binary. That's a little note I've made here. So avoid treating preferences for sustainability or not wanting sustainability as a yes or no. Clients' views exist on a spectrum, and there's the heart and head potential conflict as well. So they may want just a portion of their portfolio to reflect their values or screen out specific sectors. And your job as advisors is to uncover the nuances and make sure that the client is actually getting what they want in a way that meets their requirements. They may have different views depending on the different time horizons and the different products that you are advising them to take out. So basically, have the conversation.
Brilliant. Yeah, I've got a few more. Next one being be alert to emotional drivers. So responsible investing can be really personal and also emotional. So if a client expresses strong preferences, you may consider whether this signals vulnerabilities, what I was talking about earlier, the climate grief or anxiety. And then the response must be met with appropriate care and documentation. Next one, embrace the SDR and educate clients on it. So the new SDR labels and disclosures really offer clarity and structure. And advisors have got a huge opportunity here to be the translator. And then my last one is to champion trust through transparency. So the FCA targets greenwashing and boosts fund disclosures. The advisors, you can lead by example. So show your clients where their money is going, how it aligns with their values, and what it is actually achieving with honesty and realism. Really important.
Yep, brilliant ones. And I'm going to have the last one, I think. And I think we see an opportunity in the gender and wealth transfer gap. I mean, you
Yeah.
referred to that earlier, Ellie. I mean, the growth in female wealth ownership and the sustainability orientated preferences of women represent a huge opportunity for more tailored and inclusive advice.
Yeah.
Okay, that wraps it up. Another one under our belt.
Yep.
Well, another one of two. So we're getting there. We've got momentum now.
Yep.
There's been a lot to digest and a lot of opportunity. Don't forget to subscribe to Accord Talks on Spotify and various other channels. And if there's a topic you'd like us to cover in future episodes, drop us a message via our website or on LinkedIn. And we'd really love to hear from you.
Yeah, thanks so much for joining us for this second episode of Accord Talks. And a big thank you to our Accord Initiative partners who make it possible for us to spend time producing the podcast for you. So we've loved it. We hope you have too. See you next time.
Thank you.